When, we started in 1998, which seems like a couple lifetimes ago at this point, the PERE market, really the investment market here was in its infancy. And, the market itself at that point was basically, opportunity funds were operating with, all 100% foreign capital that were focused on the non-performing loan market. As I mentioned earlier, there was a few groups such as we were that were focused on hard assets. So the market started to change actually pretty quickly in September 2001 when the J-REIT market was launched, which provided liquidity for the PERE investors at that time and allowed the market to grow very quickly. So while the early days were dominated by opportunistic investors, by probably 2005, we started to see private equity investors entering the market that had lower return requirements, more kind of, I wouldn't necessarily say core plus, but certainly more value add type of return requirements. As we've seen, the market has really grown since that period of time, where now, it's really more dominated by core and core plus for the last few years. Where does it go in the future? That's a very good question. I think that this market, the Japanese economy and market, are continuing to be in a low interest rate environment, which is very conducive for the core and core plus investors, which I think will likely to be the most active going forward. That said, there's still going to be market dislocations in some sectors, and I think that will provide opportunities for higher yielding investors. But it's just going to take a little bit of time. And I think with the currency issues we have now, with the yen being so weak and inflation, we're going to start to see market dislocations probably sooner than later would be my guess. Well, I think it's tough right now because, a lot of development deals right now are really kind of being underwritten to more core plus type of returns. Because domestic capital is so cheap to do that. In order to compete, you've really got to be willing to accept lower development returns, which, a number of investors are willing to do that here. I think that, hospitality is going to make a comeback, but I think you still have a lot of owners in that, there were a lot of residential developers that suddenly became hotel owner and operators very quickly before COVID. And, I think you still got a lot of stress in that sector. I think that there'll probably be some interesting, more kind of value add type of plays in the hospitality sector going forward. I think with retail, it's going to be interesting to see how the retail market recovers after COVID. Japan likes retail a lot. I think high street retail is going to continue to be fine, but I think that suburban retail, there may be some opportunities for especially for repositioning of assets in the suburban retail sector that you potentially can end up with some higher returns on. And, lastly, the Japanese banks, have been quietly selling off non-performing loans, certainly not anywhere near the extent it was years ago, but they still do have non-performing loans and they're quietly selling those, which clearly have to be sold with investors getting a higher return on their capital to do those deals. So I think those are probably the property sectors where you're going to start to see, where I shouldn't say you're going to see, but where higher yielding investors are going to have an opportunity to obtain their returns. Good question. I mean, in my view, I think climate change is the greatest risk affecting our industry, if not affecting the world right now. I think as property stewards, we've got a responsibility to do all we can to lower carbon emissions from existing assets. A lot of developers, I would say probably, almost all developers now are constructing net zero buildings, which is great. But, I think lowering carbon emissions and reducing energy costs on existing buildings is critically important now. And I think that's where we need to change the focus a lot. There's a great deal of talk about ESG and energy efficiency, but the real key is implementation of initiatives to do that, and that's where I think what we're trying to do at SAS with our 360-degree sale leaseback is we're actually trying to make sure we implement these initiatives, not just talk about it and not just have a program, but actually do something about it. And I think that's what needs to be done. There needs to be more action and less talk, to be perfectly honest. More and more institutional investors, as they implement ESG targets, it's going to be incumbent on the PERE community to align these targets and actively partner with tenants to be able to reduce carbon emissions. It's not going to be very long in Japan where, where non-ESG compliant buildings are going to have very difficult time finding tenants and buyers. It's going to become very bifurcated market on buildings that are either certified and buildings that aren't. And there's certainly a lot of small office buildings which are not going to be able to be certified going forward, where I think it's going to be a very challenge for these owners to try to A, find tenants, and B, try to find any buyers for liquidity for that. So I think ESG is a critical issue that needs to be addressed right now in the marketplace. And we're doing what we can, with my little shop here to try to do that. Well, it's a very good question. I think when you look at, so if you look at a sale leaseback where we have a 10 or 20-year lease, it's very easy for us to implement this and get a return back on the investments. That's why I really like our 360-degree sale leaseback, because it's just a natural fit to be able to implement energy efficient savings as part of the program. When you get into more short-term owners, closed-ended funds that have a shorter life, it becomes a lot more challenging for them to be able to try to do that over a period of time. But again, I think that right now you can start to quantify the effect of ESG and lower and certifications. I think there has been data in Japan now showing that you can get higher rents by buildings that have been retrofitted and are certified on existing buildings. There was a presentation I saw a couple months ago by Mitsubishi Jisho that demonstrated that on one of their buildings. And, right now, I don't think we can actually say the exit caps are affected in Japan yet. But I have talked to somebody in Australia where they're actually able to show that there's a very positive impact on ESG compliant buildings, with basically getting better pricing on an exit than non-compliant buildings. So that's going to be an issue where you need to do a cost benefit analysis and figure out on a shorter term basis if you're going to get your benefits, and looking at both potential rent growth as well as your exit value, which would potentially be higher at the end if you implement this. While you may not get a direct return on your investment per se, you will at the end. And so I think that's how people are going to start, if they haven't already, to start to look at implementing energy efficient retrofits on existing assets. Main challenge right now is too much capital and too few deals. I don't know anybody in the market who isn't crying the blues over, the competitiveness of all the capital and not enough deals. So, I think, as you go up the risk return spectrum, I think that becomes even more so right now with this being dominated by core and core plus investors. That said, as I mentioned earlier, I think there will be, there's still going to be opportunities in the Japanese sector. It's always going to be around dislocations at different stages at the cycle. And I think the main thing is investors need to be very strategic, and they need to be patient, and they'll get rewarded with that. I think that there's been investors, in my view, I've seen kind of jumping in without fully understanding the risk. And I think that when they realize what the risks are, and particularly their underwriting may not be really conducive to market conditions, those might create some opportunities in the future. And I think you've also got some fund and financing maturity dates coming up that also will create some opportunities over the next 12 to 18 months. I was going to say there's Tokyo and then there's Tokyo. That used to be the case. And it's not so much anymore. I think Osaka has really done a great job of repositioning itself as its own destination, as it's really its own metropolitan area that's just not a shadow city to Tokyo with branch offices. I think they've done a very good job with that. Nagoya as well. I think Nagoya has done a great job with expanding their economy, so it's not completely focused on Toyota and automotive, but also other industries as well. And then there's Fukuoka, which very strong, tech industries down there, biotech now as well, which again has got its own reason to be there. And so I think those are the four main markets, certainly the ones that we focus on. Although with manufacturers, we're all over the place. But those are going to be the four I think the investors are going to continue to focus on. And I think you need to look at each market differently because it's got different opportunities because of the microeconomic conditions within each of those markets.
How do you do that? How got to?
Good question. Sometimes I ask myself that. How did I do this? It is homogeneous society. They don't apologize for it, nor should they. And it is difficult to get into the market. I mean, there's barriers to get in here. It's not easy to transact. Structuring, deal structuring here because of, tax issues and stuff for offshore investors is very complicated, time consuming and expensive. So, investors, I think they need to, they basically need to be willing to come here and learn the market. I think, the first thing anybody needs to do is they need to really look at and determine exactly what their investment objectives are and really confirm that they can achieve those in the Japanese market. Because with all the issues that are here, it's not easy, it's not cheap to do, it's expensive to set up, it's difficult to hire people. So, second is they need to find the right manager or a team that can actually implement their strategy to try to do it. They also, I think, they need to be very flexible with their strategies because the market changes here. And, I've seen investors, I actually have been one years ago where we set up a fund early on and we had very rigid investment criteria. The market changed and left us high and dry where we couldn't place the money because we were, thinking we were too cute with having this rigid strategy. So you need to be flexible with that. And again, I think, the two things I mentioned this earlier is I think, that you need to be very strategic when you're in Japan and you need to be very patient. As a guy who is notoriously is impatient, it still kind of amazes me 23 years later that I'm still here. And I guess that means I've developed a certain level of patience, although I'm sure there's some people on this webinar that would strongly disagree with that. The answer is yes. I think it still is an attractive sector. I think one of the reasons is because of growing e-commerce and strong tenant demand. I think the problem and the hesitation with the sector now is rents, is with inflation and the increased costs of the tenants and the operators. Are they going to be able to absorb higher rents, or are we going to start to see some downward pressure on logistics rents? I tend to think that dependent upon the market, but I think particularly maybe in the greater Tokyo area where you've seen the rents rise the highest, I wouldn't be surprised if there isn't some downward pressure on rents. I don't think it's going to be huge downward pressure. I don't think rents are going to, go down by 10% or anything like that. But I think that you're going to see some downward pressure on rents. Other markets where demand remains strong and they're not, you don't quite have as much product coming online or is online. I think you'll probably be okay. Are you going to get real strong rent growth? Maybe not what you underwrote, but I still think that you'll get it. Excuse me. So I think that it's still a very good sector, but it's really becoming much more of a core investment sector. So it really depends on your return requirements on whether or not it's something you should play in right now. Because there are deals being done sub 3, for Greater Tokyo area, there's deals being done at a sub 3 cap. And Osaka, we've already seen a sub 4 cap. So I guess another way to answer is I would probably rather buy a logistics asset at a sub 3 cap than a residential asset at a sub 3 cap, I think is a way to put it, because I think you've got greater upside with logistics. And I think you have more of a stable rent base with logistics than you do with residential going forward. I think it's becoming more and more important all the time. I think it's becoming really, as I have, as I've talked to investors, to institutional investors, and talked to other managers, it is becoming more and more important where they want to know. They basically, as I mentioned earlier in the questions with Ethan, they want you to understand what their ESG programs are. They want you to implement them. They want you to become a partner with them on implementing their programs. So I think it's becoming much more important. And I think going forward, it's going to be one of the real issues, I think, on manager selection these institutions are going to have. And I think that's why I think you're starting to see, all of the large managers all embracing ESG and are hiring, directors of ESG investing to be there to oversee the whole thing. It's going to become a much, let's put it this way. I think managers who don't do it are going to become dinosaurs and will be out of business before long. I think it's that critical to do. I think BlackRock, you've probably seen a lot of issues they've had, not necessarily not on the PERE front, but in general, where they've had, some states in the U.S. They don't want them to get out of investing in fossil fuels and other, kind of dirty industries, if you will, from an ESG perspective. And BlackRock has actually stood up to them and said, no, we've got an obligation to do this. So I think you're going to see more and more managers need to take those stands to try to do it. I do see it happening, but it's taken a long time to try to do it. And there's been a lot of resistance, and there will continue to be resistance. You have a lot of Japanese companies that are very set in their ways, rather. Well, they're set in their wages too, which is another issue on the lack of wage growth, which again is probably a topic for another webinar. But they're set in their ways and they're very resistant to change, right? I mean, I think Japanese companies, they hate change. They really don't like it at all. And so you have to be very careful on how you approach them with things that are seen as change. And again, that's where the patience comes in, to try to do that. So I think there has been a movement, and you've seen some companies adapt very quickly to things. And I think those companies are actually, if you look at their stock prices and everything else, they're doing actually very well. The other ones that are more resistant probably aren't doing so well. Somebody who tracks companies a lot now with our program, we see that. So it is, but it's just, it's a process, and it's going to continue to be. But there's one where I think, certainly for the remaining part of my career, I think, the resistance is not going to go away. And I suspect there's going to be a lot of resistance going forward. We had kind of, I think early on, we had thought that there would be a generational change as you started to get younger people in, particularly people that had gone to school overseas or worked overseas. they would start to be a little bit more receptive to change. You know, I kind of thought the same thing about the political system in Japan, but it seems to be once even the ones that have educated and worked overseas, when they get into those roles, they revert back to what their predecessor did. And so that generational change has not occurred nearly to the extent that I would have thought would have happened before. Potentially, you know, I think it will going forward, but it's just going to be a long process.